Chapter 15, Convertible Securities. When you hear the word convertible, don't think of a sports car with a removable roof. Think of something even more fun. Fixed income securities that can be exchanged for common stock. Now I know your excitement is through the roof because of that statement. Convertible securities are somewhere in the middle and may be appropriate for Goldilocks investors that want a higher return and are willing to bear higher risk than U.S. Treasury bills, but also want lower risk and are willing to accept lower returns than common stocks and derivatives. One thing to remember is the value of a convertible security is related to its value as debt or preferred stock and its value as common stock. This can be both a plus and a minus. When interest rates rise, the prices of convertible bonds and convertible preferred stocks decline. So let's begin our discussion of Chapter 15. Features of convertible bonds. Convertible bonds are debentures, that is, unsecured debt instruments that may be converted at the holder's option into the common stock of the issuing company. Since the firm has granted the holder the right to convert the bonds, these bonds are often subordinated to the firm's other debt. They also tend to offer a lower rate of interest or coupon rate than is available on non-convertible debt. Therefore, the conversion feature means that the firm can issue lower quality debt at a lower interest cost. Investors are willing to accept this reduced quality and reduced interest income because the market value of the bond will appreciate if the price of the stock rises. These investors are thus trading quality and interest for possible capital gains. Convertible bonds are always callable. Remember that. Convertible bonds are always callable. Convertible bonds are attractive to some investors because they offer the safety features of debt, which means the firm must meet the terms of the indenture and the bonds must be retired if they are not converted into stock. Since the bonds may be converted into stock, you will share in the growth of the company, which is also something that is enticing to potential investors. Like all investments, convertible bonds subject you to risk. If the company fails, you would lose all the funds you invested. This is particularly true with regard to convertible bonds because they are usually subordinated to the firm's other debt. Convertible bonds are less safe than senior debt or debt that is secured by specific collateral. However, your position is still superior to that of the stockholders. Convertible bonds are actively traded and their prices can and do fluctuate. Their price is partially derived from the value of the stock into which they may be converted. Fluctuations in the value of the stock produce fluctuations in the price of the bond. Remember, the benefit of being able to convert to common stock is not free. It was received in exchange for a lower coupon rate. The valuation of convertible bonds as stock. The valuation of a convertible bond is derived from, one, the value of the stock into which it may be converted, and secondly, into the value of the bond as a debt instrument. The valuation of a convertible bond is a bit more complex than valuing a simple bond or a simple stock because it is a hybrid security that combines both debt and equity. The value of a convertible bond in terms of the stock into which it may be converted depends upon the principal amount of the bond or face value of the bond, the conversion or exercise price per share of the bond, and the market price of the common stock. So, number of shares into which the bond may be converted. So, for example, if a $1,000 bond may be converted at $20 a share, the bond may be converted into 50 shares. And then the conversion value of the bond as a stock is C equals future value divided by P times P to the S subscript. So when we look at Exhibit 15.1, we look at the relationship between the price of a stock and the value of a convertible bond. The price of the stock is given on the horizontal axis, the convertible bond's value as stock C, shown on the vertical axis. As the price of the stock rises, the conversion value of the bond increases. The market price of a convertible bond cannot be less than the bond's conversion value of stock. And then when we look at figure 15.1, that shows the relationship between the price of the stock and the conversion value of the bond. Again, you see as it increases, as the price of the stock increases, it also increases to the conversion value of the bond. So at $30, if the price of the stock is $30, the conversion value of the bond would be $1,500. The valuation of convertible bonds as debt. The value of a convertible bond as debt is related to the annual interest or coupon rate that the bond pays. The current interest rate being paid on comparable non-convertible debt, and finally the requirement that the principal or face value be retired at maturity after so many years if the bond is not converted. If a convertible bond matures in 10 years, pays a 5% annual interest payment, and the yield on a comparable non-convertible debt is 8%, what is the value of this bond as a straight debt instrument? So the future value would be 1,000, the payment is 50, interest rate is 8 for 10 years, and the present value would be $798.70 if you put that into your financial calculator. Figure 15.2 shows the relationship between the price of a stock and the value of the bond as a non-convertible debt. And it kind of shows how you go through the process of, if you do the long math, using that to each year. And so what we come to is that value of that $798.50. And the future value, like we said, was $1,000. And so when you do the math and convert it out, the present value would be $798.50. Exhibit 15.2 shows the relationship between interest rates and the value of the bond. And so you can see there, as the interest rates increase, the value of the bond decrease. And so the coupon rate would stay the same at 5%, but notice that at an interest rate of 3%, the value of the 10-year bond would be $1,170.60. If the interest rate goes to 12%, then the value of that bond drops to $604.48. The bond's value as a hybrid security. The market price of the convertible bond combines both the conversion value of the bond and its value as non-convertible debt. If the price of the stock were to decline below the exercise price of the bond, the market price of the convertible bond would be influenced primarily by the bond's value as non-convertible debt. In effect, the bond would be priced as if it were a pure debt instrument. As the price of the stock rises, the conversion value of the bond rises and plays an increasingly important role in the determination of the market price of the convertible bond. At sufficiently high stock prices, the market price of the bond is identical with its conversion value. In effect, the bond would be priced as if it were pure equity. If you look at figure 15.3 on page 305 of your textbook, it gives us the minimum price of a convertible bond. And the relationships are illustrated. Figure 15.3, and it adds to the market price of the convertible bond. For prices of the common stock below P, the market price is identical to the bond's value as non-convertible debt. For prices of the common stock above P, the price of the bond is identical to its value as common stock. You can see there in figure 15.4 the two lines there, P with the subscript of M to P subscript S1, they combine as the price of the stock increases and the price of a convertible bond. And so the values merge there, and you can see as it increases how those two lines come together and merge, and that gives you the value of a bond. Premiums paid for convertible debt. One way to analyze a convertible bond is to measure the premium over the bond's value as debt or as stock. For example, if a particular convertible bond is commanding a higher premium than is paid for similar convertible securities, perhaps this bond should be sold. Conversely, if the premium is low, the bond may be a good investment. A lower premium is not a sufficient reason to acquire a convertible bond, but it may suggest that the bond be considered for purchase after further analysis. The premium that an investor pays for a convertible bond may be viewed in either of two ways: the premium over the bond's value as stock, or the premium over the bond's value as debt. The premium rises as the price of the stock rises because the debt element of the bond becomes less important as the stock price rises and causes the as converted value of the bond to exceed its face value. Exhibit 15.3 gives us the premiums paid for convertible debt, and that is found on page 307 of your textbook. And then figure 15.5 shows the premiums paid for a convertible bond. One of the things to remember is as the price of the stock rises, the safety feature of the debt diminishes. In addition, as the price of the stock and hence the price of the convertible bond rises, the probability that the bond will be called rises also. Convertible bonds offer investors the opportunity for some capital growth with less risk than owning stock. Convertible preferred stock. Although convertible preferred stock is similar to convertible debt in some ways, there are important differences also. The differences are primarily the same as those between non-convertible preferred stock and non-convertible debt. Preferred stock is an equity instrument, and convertible preferred stock is preferred stock that may be converted into common stock at the option of the holder. Value of convertible preferred stock. Minimum value of the convertible preferred stock must be equal to the conversion value of the stock. And so we have that, again, the conversion value of the stock is P subscript E. And then you have P subscript E equals P subscript S times N. N is the number of times, or the number of years we're looking at to which it would be converted. Value as non-convertible preferred stock is related to the dividend it pays and the yield earned on competitive non-convertible preferred stock, or K. So one of the things that we must remember is when a company issues a convertible bond, the expectation is that the bond will never be redeemed. Management does not plan to retire the bond. Instead, management expects to compel the investors to convert the bond into common stock. Once the bond is converted, it ceases to exist, and so it's no longer debt. To force conversion, the value of the stock must rise. How much of an increase in the price of the common stock is necessary for the company to compel the bond's conversion to stock varies, but you can draw some common sense conclusions. So, if $1,000 bond is convertible into 50 shares at $20 per share, the price of the stock must exceed $20. Otherwise, the conversion value is less than the $1,000 face amount, and the company calls the bond. No one will convert the bond into stock. Instead, they will all accept the face value of the bond. Secondly, the price of the stock must rise sufficiently to also cover any call penalties. An investor will not convert unless the value of the stock exceeds the principal plus any and all call penalties. So, if the $1,000 bond has a $50 call penalty, the price of the stock must rise to at least $21 to cover both the $1,000 principal and the penalty. The call price of $1,050 includes this $50 call penalty above the bond's $1,000 face value. One of the things to remember, however, is that companies are going to want to entice investors to convert these. So in order to do so, the companies have to be able to raise its stock price to a level to where it will entice and people can make capital gains. The price of the stock must therefore rise sufficiently to allow for the possibility that the price of the stock may decline and still be high enough that investors will convert to stock so that the company does not have to pay cash to redeem the bonds. It is reasonable to assume that as the price of the stock rises above the conversion price, the probability of the bond being called increases. As an investor, if all you earn is the yield to maturity, you're going to be disappointed. If that was the case, you would have been better off buying a non-convertible bond that would have paid more interest and generated a higher return. A primary reason for buying a convertible bond is to participate in any increase in the price of the stock of that company. Why would investors buy convertible securities? Convertible securities may be appropriate for investors that want a higher return or willing to bear a higher risk than that of taking simply a U.S. Treasury bill, but also they want lower risk and are willing to accept lower returns than common stocks and derivatives. This concludes chapter 15 of our text. Be sure that you read chapters 14 and 15. Watch both PowerPoint lectures for both chapters and watch any additional videos that I may post that are related to these topics. Also, make sure that you are completing your discussion board post and respond to at least 2 of your classmates' posts. And as always, have a blessed week.